Welcome to the channel, guys. If this is your first time here, my name is Dr. Lemuel Oliver, and this is LemuelOliverMD.com. We're a channel that is dedicated to earning passive income primarily through investing in real estate. And if you're interested in learning more about getting started investing in real estate, subscribe to the channel. We release videos all the time that talk about getting started investing in real estate. And so let's go ahead and dive into our discussion for today. Now, again, there are 6 primary metrics that we want to take a look at in terms of determining the state of the real estate market. And the first metric that we're going to take a look at is the market type. And so what we want to know in terms of market type is, are we dealing with a seller's market or are we dealing with a buyer's market? And so the way we know whether or not we're dealing with a seller's market is the inventory and demand. With a seller's market, you see low inventory and high demand. You also typically tend to see the days on market for the listing are very low. You have low days on market for the listings, and you also tend to see homes being sold at or above asking price. Now, in terms of a buyer's market, you see the opposite. You typically will see high inventory and low demand. You see high days on market in terms of the listings, and you'll see that homes are being sold below asking price. And so with the way things look in today's market, I think it's very safe to say that we are definitely in a seller's market. Now, the next thing we want to take a look at is construction spending. And there are 4 areas inside construction spending that we want to take a look at. First is the total monthly construction spending, then the architecture billing index, followed by permits, and then housing starts and completions. And so let's start by taking a look at total construction monthly spending. And now this is something that is tracked by the Census Bureau. And what you'll see is that the residential construction spending will typically account for about half of total construction spending. And so let's take a look at this. So we can see that construction spending for March of 2021 was $1513 billion. And then in February of 2021, it was $1509 billion. And so it's not so much the raw numbers that we're concerned about. We're actually more interested in the actual trend. And so if we zoom in on this a little bit here, we can see that it's divided into public and private sector spending to get the total. And the public spending has been pretty flat, certainly relative to the private spending. We can see that it is the private construction spending that is the thing that is really driving the total construction spend. These 2 lines essentially parallel one another. And we can see that private spending, total spend is kind of flattening, but private spend, these are both on the rise. And so that's an indication that the market is growing strong. Now, again, you can expect the residential spending to be about half of the total construction spending. Let's back out a little bit and take a look at that. So we can see in March of 2021 that the total construction was 1.5 million, and this is in millions of dollars. So 1.5 million here, and the residential was 734,000. So about half. You can expect the residential construction spending to be about half of the total construction spend. Now, the second metric that we want to take a look at here is the architecture billing index. And think about it this way. One of the very first things that you want to do when you take on a construction project, you want to, especially if it's a non-residential, one of the first things you want to do is you want to discuss it with an architect. Once you get the architect's plan, you want to obtain the permit to actually start the construction. And then once you obtain the permit, you actually start the construction. And once the construction is complete, then you actually still need to sell the property. And so the Census Bureau does a good job of tracking that entire process. And one of the very early indicators is going to be the architecture billing index. And so let's take a look at that. So with the architecture billing index, we can see that it is a 9 to 12 month lead indicator for the overall, or the local and the overall economy. And it's for non-residential construction, but we know that about half of the total construction spend is going to be residential. And so Having that information allows us to extrapolate what we know about the Architecture Billing Index in terms of non-residential construction. What we know about that allows us to extrapolate that information and figure out what's happening with residential spending. So let's take a look at the Architecture Billing Index. So with the Architecture Billing Index for March of 2021, we can see that they analyze the data nationally, by region, by sector, and by practice. And so when we take a look at the billing index on a national level, and this particular graph goes back to March of 2020. Let's see if we can get the whole graph on the screen here. And we can see that the design contracts are represented by gray, the inquiries are represented in orange, and the billing is actually represented in the red and the green. And the above 50 is the green, the below 50 is the red, and we can see no change from previous. And so we can see our 50 line here, and early in March of 2020 we can see that the billing was down quite a bit. We can see our design contracts were a little bit actually higher than our inquiries, and so this would suggest that the inquiries had started to fall off before those design contracts were finished. And we can kind of see these lines flip here in April of 2020. People started to inquire, and then once they did, we can see that the design contracts follow suit. And you can see how the inquiries sort of lead the way in terms of figuring out what's going to happen with the market, because that's followed by your design contract, and then that is followed by the actual billing itself. And they analyze this data, they track it regionally as well, the West, the Midwest, the South, and then the Northeast, and it looks like the billing is up across the country. Then they also track it by sector here, commercial versus industrial, then institutional, and also residential. And again, we can see that it is up across the board in terms of sector. And one of the final things that they take a look at is the actual practice, the profession of the architecture profession, and taking a look at how healthy that profession is doing in terms of emerging professionals, licensed architects, non-licensed, their technical staff, their billing staff, their non-technical staff. Having a sense of how well that industry is doing is one of the lead indicators of how the economy is doing, and in turn how the real estate market is doing. Now, permits. Now, we talked a little bit about this earlier. This is another thing that is tracked by the Census Bureau. After you've obtained your plan from the architect, the next step is to actually obtain a permit. And so this is something that is tracked by the Census Bureau as well. And so we take a look at permits by United States and regions, and it looks like this downloads in a spreadsheet. So we'll just take a look at this. All right, so we can see that privately owned housing units authorized by building permits, permit issuing places. And so this data looks like it's released annually. Let's see, monthly. Okay, so we can take a look at what's happening monthly here. And so privately owned housing units, building permits, issuing places. So we can, and this is in millions of dollars. And so they actually look at the spend on permits. And so in March of 2021, we can see that there was a good bit of increase in the spending on permits as opposed to February. Looks like February was down a little bit from January, but we can see that March is certainly increased. For 1 unit, things are up. For 2 units, looks like things are up. Looks like spending on permits is up for 3 to 4 units as well. And for 5 or more units, the permits are up. And then in the Northeast, permits are up. And 1 unit, permits are up. Midwest, permits. So it looks like permits are up across the board month over month. And let's see, if we look at March of 2021, if we look at March of 2020, we can see that it's about 10,000 points higher on this scale. We look at March of 2020. Yeah, so we can essentially see that year over year, the month over month and year over year, the permit spend is definitely on the rise. And so again, this is an indication of a strong and growing real estate market. Now, one of the next things that we actually need to take a look at is the actual housing starts and completions. And so let's take a look at that. So total new housing starts and completions. Again, this is something that is tracked by the Census Bureau as well. Let's take a look at their website. Quarterly starts and completions. Now, this information is tracked quarterly, but it looks like it's only released yearly. I couldn't find any information specifically for the first quarter of 2021. The most current information I was able to find was 2020, and we can see that this is in thousands of units, so 990,000 total single-family homes, new construction single-family homes were built in 2020, and that's up over 2019. And built for sale, 765,000 fee simple. If the owner already owns the land and they just pay the contractor to build a house, this is that number. And then we can see that they break it down by contractor built, owner built, detached, median, and average square foot or floor area. And one interesting thing that I noticed was that the homes in 2020 were actually slightly smaller than they were in 2019, but that looks like a trend that's been going on since 2017. It looks like the houses have been getting a little bit smaller over the years, and this is something that typically tends to go in cycles as well. Now, for actual new home sales, it's one thing to actually inquire of the architect and get the permit and start the construction and finish the construction, but it's another thing to actually sell the home. And so that's another thing that the Census Bureau also tracks as well. So if we take a look at the actual sale of newly constructed homes, quarterly sale by price and financing. Yeah, so we can see that in the first quarter, actual sale of new construction homes in thousands of houses. We had 243,000 homes sold in the first quarter of 2021. So if we look at the first quarter of 2020, we see that we were only 181,000, which that was actually up from 2019, 174,000. But then if we look from the fourth quarter, we can see that it's up 202 in the fourth quarter of 2020, 243. So the sale of newly constructed homes definitely on the rise. And so again, that is certainly an indication of a strong and growing real estate market. And home sales. So pending home sales is something that is tracked by the National Association of Realtors, and this is one of the early indicators of actual sold houses. And you have to keep in mind that 90% of all home sales are of existing homes. The new construction only accounts for about 10% of home sales. And so the National Association of Realtors actually do a very good job of tracking all home sales, and they do it based on pending home sales. And this is a lead indicator of housing activity based on signed real estate contracts for single family homes, condos, and co-ops. And what we mean by co-ops is that is when two parties have agreed to purchase a home but each of them will only pay for the portion of the home that they are going to use. And this is a common enough arrangement that it is something that is tracked by the National Association of Realtors and also by the Census Bureau. And so you can expect the pending home sales to lead the actual home sales by about 1 to 2 months because of that 30 to 60 day closing window. So let's take a look at this National Association of Realtors chart here and see what's happening with pending home sales. And we can see that in March of 2021, pending home sales are up 1.9% month over month. And so pending home sales, March of 2021, month over month up 1.9%. The pending home sales index is 111.3. And now 100 is considered the baseline, and 100 is based on the pending home sales of the activity of pending home sales of 2001. And so we can see that 2021 we're up 11.3% from where we were in 2001. And so again, you can see that home sales are up. And let's see, national or state level home sales and local market. Let's take a look at what we have here. Now, this is something, CoreLogic is a site that I typically use to screen residents, but they also have some very useful information about the housing market in general. And we'll take a look here and see that the home prices nationwide. We can see that 11.3% year over year. So the home prices in March of 2021 are up 11.3% from where they were in March of 2020. And we can see that they're up 2% from February of 2021. And the thing I like about CoreLogic also in terms of their home prices is they actually give us a forecast. They're projecting that the home sales are going to be up in April of 2021 from March of 2021 by 1.1%. And they're projecting that in March of 2022 that the home prices will be up another 3.5%. And so it looks like the market is projected to continue to grow. Now, no discussion of a state of the real estate market can be complete without a discussion of foreclosures. And so we need to take a look at that. And Adam Data Solutions is one of the leading companies out there that takes a look at foreclosure data. And I think one of the easiest ways to think about it without getting too in the weeds in terms of foreclosures is to do it the way Adam does it. And what they do is they congregate their foreclosure data primarily into all properties that have default notices, that have been scheduled for auction, or that have gone to auction and not sold and have been actually repossessed by the bank. And so that metric is up 9% from the fourth quarter of 2020. However, that is still down 78% from the first quarter of 2020. And so we can see that foreclosures are at an all-time low right now. The federal government's foreclosure moratorium has foreclosures at historic low, down about 80% from the first quarter of 2020. So let's take a look at the actual site here and see what they have to say. In uncharted times, loans 90 plus days past due reach unprecedented levels. And so if we take a look at this graph here, we can see that it goes back to January of 1999 and it goes through January of 2021. And the early stage delinquencies are in blue. The 90 plus days delinquencies are in orange. The actual in foreclosure is in gray here. And so what we can see is around that 2008, 9, 10 time frame, that last housing crash, we can see that our 90-day delinquencies got up over 40%. And we can see that today, or in January of 2021, that was up over 60%. And we can see that in that 2020 time frame, once that moratorium on mortgages went into place, the early stage delinquencies just fell off of a cliff. But then people were not paying, and so the 90-day delinquencies just shot right up. But the thing that's different this time is that because of the moratorium, there are no foreclosures. And so we can see that foreclosures are at an all-time low. And so this is an unprecedented sort of situation that we find ourselves in with the real estate market right now. I mean, it's hard to imagine that we have a 20% higher rate of 90 plus day delinquency here in January of 2021 over where we were with the last housing crash. It's hard to imagine that we won't see an uptick in these foreclosures at some point. But again, these are unprecedented times, and this is one of those metrics we're just going to have to watch and see how this thing plays itself out. Next is financing. So if we take a look at what's happening with financing, in terms of financing, you typically will have either a fixed rate mortgage, an adjustable rate mortgage, or an interest only mortgage. And the prime interest rate of today, as of today, is 3.25%. And capital remains very inexpensive. And so a lot of people would say you would be crazy not to borrow the money and go ahead and purchase that property. And with the price of the money right now, I would tend to agree with that. And so finally, if we take a look at current market conditions, we see nationwide that inventory is at a historic low. Demand remains very high, and millions of millennials are becoming first-time home buyers. And prices are up about 16% on average across the country. And a lot of that has to do with inventory. New construction has lagged since the last market crash. It really hasn't caught up, but now it looks like that's changing. Steel and lumber prices are at historic highs, doubling and even tripling in some places, but interest rates remain at historic lows. And so if we take a look at things on a regional level, again, this is when we looked at this earlier, but we can see by region how things look with the National Association of Realtors in terms of the pending home sales. You can see by region how that looks. And local home sales. Now, Rocket Homes does a good job of actually forecasting the local market. I am in the Memphis market, and Rocket Homes provides a trend report here. And we can see that as of April of 2020, Memphis remains a seller's market. The median sales price of a home was $160,000, up $22,000 from April of 2020, a 16.7% increase. And sales price by bedroom count, we can see how that looks. 16.2% for the 3-bedroom homes. And we can see that the prices here, the prices take quite a jump when we go from that 3-bedroom to the 4-bedroom and even the 5-bedroom homes. And it's actually the 5-bedroom homes and the 2-bedroom homes are the two sectors that have increased the most. And most of these 2-bedroom homes are going to be investment properties. And we can see the median sales price for Memphis and then some of the surrounding cities. The inventory in March, 2645, and April, 2818, an increase of 6.5%. And the number of homes, 1,400 3-bedrooms. So this 3-bedroom, 2-bathroom homes are still one of the most numerous home types across the country today still. Number of homes sold in March 576, April 509, down 11.6. And a lot of that has to do with inventory. As we take a look at asking price versus sold price, 159 homes sold under asking price, 31%, 30% sold at asking price, and 39% over asking price. So again, it looks like we are definitely in a seller's market. And one of the things that I also like to do when trying to figure out the state of the real estate market is actually take a look at my own portfolio. And so we'll take a look at that. So we'll take a look at Tenant Cloud here. Now, 2019 was the first full year that I have data in Tenant Cloud. And so what we'll do is take a look at the first quarter numbers for 2020, for 2021, see how that compares with the fourth quarter of 2020, and then also see how the first quarter of 2021 compares with the first quarter of 2020. So if we go to reports, January of 2021, and it's going to be March 31st. So we want to do first quarter of 2021, and we want to leave active leases off. We want to do all properties, and we want to do cash. And so what we're going to do is take a look at the first quarter of 2021, compare that to the fourth quarter of 2020, and then also to the first quarter of 2020, and see how that looks. And so we're going to generate one report for all properties and just do PDF. So let's take a look at this. All right, so first quarter 2021, we can see we had to spend $17,000 in the first quarter, but then we got a Jamestown Way property here that bought in $51.75. We've got a Brindlewood Lane property that bought in $6,050. We've got a 4214 address that bought in $12,356. We got a 4216 address that bought in $12,997. We got a 4218 address. This one bought in $14,697. We got a 4226 address. Looks like this one bought in $7,900. A 4230 address. Looks like this one bought in $11,000. A 4234 address. And looks like this one bought in $14,500. And so we can see that our total income for the first quarter of 2021 was a little over $85,000. $85,000 and basically $70. And so if we compare that to the fourth quarter of 2020, let's see. So we want to go back to October 1st, and we want to end December 31st. And so this is our fourth quarter of 2020. We want to leave active leases off. We want to look at all properties, and we want to do cash. So let's download this. And we want to generate one report for all properties, and we'll do PDF. All right, and so these are the same properties, and so we can see that our total income for the fourth quarter of 2020 was $66,856. And so if we look at these side by side, let's see if I can move this one over. Let's see. So we've got the fourth quarter, the first quarter of 2021, we came in at 85,000, a little over 85,000, and we were almost 67,000 in the fourth quarter of 2020. So now let's compare the first quarter of 2021 to the first quarter of 2020. And so let's see this this difference here. So we can see that from the first quarter of 2021, the rents are up 27% over the fourth quarter of 2020. So this 85,000 represents a 27% increase in the first quarter of 2021 than we had in the fourth quarter of 2020. So now we're going to compare this first quarter of 2021 to the first quarter of 2020. So let's see what we had there. So we want to do January of 2020. So we take a look back at January 1st and we go until March 31st. And we want to leave active leases off. We want to do all properties. We want to do cash, and let's download that one. And we'll just generate one report and we'll do PDF. All right. All right, so this is our first quarter of 2020. So let's move this over. So our first quarter of 2020, and this is our first quarter of 2021. And in our first quarter of 2021, we can see we bought in 85,000. And in the first quarter of 2020, let's see what we bought in. So we bought in 72,000 in the first quarter of 2020. So we can see that we're up about 17% year over year, which that pretty much lines up with what's happening across the country. And so I believe that prices really are up 17% across the country, or the market itself, the real estate market itself is up 17% across the country. So I think it's fair to say that that information that we see is reliable. At least my portfolio fits right along with what's happening nationwide. And now one of the last things that we want to take a look at in terms of considering the state of the real estate market is some indications, some of the indicators. We want to take a look at some of the indicators that might suggest that we could be on the verge of a housing bubble. And so what kind of things do you look at when you're trying to determine if you're on the verge of a housing bubble? Well, one of the first things you look at is skyrocketing home prices. You typically tend to see a drastic increase in the price of housing fueled by speculation and demand. And what I mean by speculation is there's going to be some baseline demand. The millennials, they want housing. They're looking for homes. But then with the way the prices are going, there are some investors who would normally invest in real estate. They see how these prices are going, and so they want to get in the market as well. And so what tends to happen is they drive that demand upward, which pushes the prices even higher. And so as the market prices rise, these speculators get in, driving up the market, like I say, even more, and making prices even higher. And then and so a housing bubble will typically begin as a surge in demand when housing inventory is low. And again, home prices are up about 16% across the country. One of the other indicators that you could be looking towards a housing bubble is when there are many risky mortgages in the market. When you start to see a lowering of credit standards, when you start to see a lot of high-risk loans flooding into the market. These are both indicators that a housing bubble or a housing market crash could be imminent. And then there's the national mortgage risk index. Now this helps us to determine this helps us to determine how risky the mortgages are right now. And this is something that wasn't tracked until after 2012. This was started in 2012 after the 2007-2008 housing crash. And so let's take a look at what we have in terms of the mortgage risk index. And so with the mortgage risk index, we can see that this is as frequent as this is as current as January of 2021, and we can see our risk index is 11.2%, and we had a high of 13.4% in March of 2019, and we had a low of 10.5% in June of 2013. And so 10.5% low. Right now we're at 11.2, so that's about 70 basis points. And what we mean by basis point, 1 basis point is 1/100th of 1%. And so we're up 70 basis points here. So we're not real far from the low point of in terms of mortgage risk. But to make more sense of what we mean by mortgage risk, and so what they do is they look at some of the factors that make up the borrower. They look at circumstances pretty much surrounding the borrower, surrounding the loan. They look at the credit score. They look at the current loan to value. They look at the debt to income ratio. They look at the long term, the arm status, and then the agency. And so what we can see, so what this 11.2% means is that 11.2% of the loans that were made in January of 2021 would have started to go down that foreclosure path had these same circumstances been in place in 2007. And again, on the low, we're looking at 10.5. So what this means is that in January of 2013, 10.5% of the loans that were made at that time, if they had been in place in 2007, then 10.5% of those loans would have started down that foreclosure path. The same thing here in March of 2019. The loans that were created at that time, 13.4% of them would have started down that foreclosure path. And so we can see where we are in terms of the mortgage risk index. And another indication that you could be dealing with a housing bubble on the horizon is most loans issued require mortgage insurance. And so the standard down payment for a property is 20%. And when buyers cannot afford to make the 20% down payment, the lenders are requiring mortgage insurance because they are considered riskier loans. And so when you see that many of the loans that are originated are starting to require mortgage insurance, that is a sign that we could be on the verge of a housing bubble. And according to housingwire.com, private mortgage insurance helped over 2 million low down payment borrowers secure financing in 2020. And this is up 53% from 2019. And then rising interest rates. This is another thing that can be an indication that we are on the verge of a housing bubble. A continuous trend of rising interest rates is a major sign of that. People who bought with these adjustable rate mortgages tend to struggle to make those mortgage payments once those mortgages get readjusted because of the rising interest rates. Because what will happen is a lot of people will buy the adjustable rate mortgage. They'll buy a 5-1 ARM or a 7-1 ARM, and that initial interest rate will be locked in for that first 5 years or that first 7 years. But then Once that rate starts to adjust annually after that locked in rate expires, if the interest starts to adjust upwards, so do those mortgage payments. And when the interest rates go up, a lot of those borrowers find themselves in a situation where they cannot continue to make those mortgage payments, and that's when they get into trouble and start down that foreclosure path. So next, let's take a look at a 30-year fixed mortgage rate chart. And what we can see is that today, well, this is April of 2021, the 30-year fixed mortgage rate is at a 2.98%. And we can see how it has changed over time. I mean, we're essentially at almost historic low. We were down at 2.72%, 2.67% in December of 2020. So interest rates have started to tick up a little bit. Looks like they got as high as 3.17% in March of 2021. But then in April, it looks like they dropped back down to that 2.97% range. And so, interest rates right now remain very low. And this 30-year fixed rate, a lot of times you can extrapolate that to your 7 and your 5 and your 7/1 arms and your interest only rates as well. And so as the homes become more expensive with the rising interest rates, you'll start to see that demand slow down, resulting in a glut of properties and the lowering of home prices. And so that's typically how things tend to play themselves out in terms of a housing bubble. So in conclusion, we are definitely in a seller's market. Construction spending is on the rise. Home prices are up 16% on average based on a year-on-year metric. Demand remains strong and supply remains limited. So therefore, we are unlikely to see the type of foreclosure rollout in the residential market that we saw with the Great Recession of 2008. But with 90-day delinquencies being at an all-time high, I cannot imagine that we will not see a significant number of foreclosure rollouts. So the takeaway is, don't wait to buy real estate. Buy real estate and wait. You got to get in the game. So I hope you guys have found some useful information with this State of the Real Estate Market address. Again, if you're interested in learning more about real estate, if you're interested in getting started investing in real estate, subscribe to the channel. See some of the links in the description below to see some of my private offerings for real estate investing. And until next time, guys, happy investing.